Hello guys, good day. Welcome to our first video lecture in ACP 313, Accounting for Government and Non-Profit Organization. I am your lecturer for this subject, Sir Jiao, and our first topic to be discussed in this subject is about foreign currency transactions. Alright, so as we all know, one of the specific business risks that an entity may face in its campaign to achieve its objectives of earning is your foreign currency risk. No? Foreign currency risk is the risk of fluctuating the value of our foreign currency related transactions. And thus, it might actually affect the entire operations of an entity and may result into a possible financial risk. But in this case, in this subject, we would like to understand how, as a CPA or as an accountant's point of view, how are we going to prepare the financial statement of an entity if such entity has a foreign currency transaction. All right. So, but before anything else, let us understand first the concept of foreign currency transaction. What is foreign currency transaction really all about? All right. So, in a strict sense, foreign currency transactions are those that are to be settled in foreign currency, regardless of the location of either party. So, as we all know, we have two types of parties. We have the buying party and the selling party. All right. So, regardless whether these parties are both foreign or both domestic parties, as long as what is involved is a foreign currency in order to settle a specific transaction, then that will be considered as a foreign exchange transaction or a forex transaction. So for example, regardless if both party are in the Philippines, the buying and the selling party are a domestic corporation, but when one of these parties are using a foreign currency transaction, a foreign currency to settle a particular transaction, then that will be considered as a forex transaction. All right. Or also, regardless when, for example, there are two foreign entities. All right. There are two foreign entities, pero these two foreign entities are using their own denominated transaction. They are, although they are foreign transaction, for example, there may be foreign entity, but for example, such foreign entity is, let us say, settling a denominated or a domestic currency, although it is a foreign entity, but it settles using a domestic currency, then that means no foreign transaction is involved. All right. So there is only a foreign exchange transaction when there is a foreign exchange denomination of transaction. All right. So these are accounted for by the domestic company by translating the amounts in foreign currency with BSP set exchange rate. So when there are instances na may settlement using foreign exchange, then such foreign currency will be translated with the central bank's set exchange rates. All right. Now, for translation purposes, guys, the exchange rate must be quoted directly where peso is expressed as the equivalent of one foreign currency. So we actually have two types of exchange rates, the direct exchange rate and the indirect exchange rate. All right. So let us understand first what is this direct exchange rate is all about. So talking about direct exchange rate, it is the number of local currency or LCUs needed to acquire one foreign currency unit or one FCU. So that means direct exchange rate is the number of peso. For example, in the Philippines, the number of peso required to acquire one US dollar, for example. All right. So in this case, let us say you are required to have 50 pesos in order for you to acquire $1. So that is direct exchange rate. The number of peso in order for you to acquire a not a single foreign currency unit. Okay? So from the viewpoint of a Philippine entity, the direct exchange rate or the direct exchange rate can be viewed as the peso cost of one foreign currency unit. So as mentioned earlier, it is the amount, it is the peso value per one foreign currency unit. All right. Now, this direct exchange rate ratio is expressed as follows, where your local currency unit, of course, in the Philippines, our local currency unit is peso will be in the numerator. So to compute for your direct exchange rate, we have here your simple formula where it has Philippine peso equivalent value or your local currency unit on the numerator and the foreign currency unit on your denominator side. So for example, um, the exchange rate is one foreign currency is equal to 25 pesos. All right. So that means to compute for your direct exchange rate, we have 25 over 1. All right. 25 over 1. So that means the direct exchange rate of peso versus your foreign currency unit is 25 pesos. So that means the direct exchange rate requires you to have 25 pesos to acquire one foreign currency unit. Alright? Now, if ever, for example, the entity is required to generate 20,000 foreign currencies, no? Whether unsa na siya na foreign currency, whether it's a dollar, yen, or rupee, or any other foreign currency, then that means how much peso amount will this entity is required to generate in order for it to acquire 20,000 foreign currency. So as mentioned earlier, we already have computed that our direct exchange rate is 25 pesos by having 25 at the numerator over peso or one foreign currency unit at our denominator, having our direct exchange rate at 25 pesos. And if we are required to have 20,000, then that means we need to generate 500,000 pesos. Okay? We need to have 500,000 pesos in order for us to acquire 20,000 foreign currency rate. Okay? So that means in simpler thoughts, guys, talking about direct exchange rate, it's the number of peso you are required to have in order for you to acquire one foreign currency unit. Okay? So that is our direct exchange rate. Now, on the other hand, our second type of exchange rate is our indirect exchange rate. So, direct or indirect exchange rate, it's the exact opposite of your direct exchange rate. So, the indirect exchange rate is the reciprocal of your direct exchange rate. So, from the viewpoint of a Philippine entity, the indirect exchange rate can be viewed as the number of foreign currency units that 1 peso can acquire. So that means kung ang ato ang direct exchange rate is the number of peso in order for you to acquire one foreign currency, sa indirect exchange rate naman is it is the number of foreign currency required to buy 1 peso. Alright? Baliktad. Earlier, sa direct exchange rate, the number of peso required to buy one foreign currency unit. Pero diri sa indirect exchange rate, it actually computes the number of foreign currency unit required in order for you to have one local currency unit or one domestic unit. Okay? So in this case, the ratio to compute the indirect exchange rate will be the exact opposite of the formula to compute for your direct exchange rate, which is, in this case, your numerator will no longer be the Philippine peso, but rather the foreign currency unit. Okay? So, at the top, we have foreign currency unit, and in your denominator, you have your Philippine peso equivalent value. Okay? So, in the preceding example, one Philippine peso could be converted into zero point 0.4. Okay? So, to compute for our indirect exchange rate here, let us say we have here. So to compute for our indirect exchange rate using our previous example, we have 1 over 25. All right? So if we will compute 1 divide 25, so that means we have 0.04 foreign currency, no? Now, that foreign currency, it depends on the problem, whether it's US dollar or yen or any other foreign currency unit. So it only means that it only requires you to have zero point zero 0.04 foreign currency to acquire 1 peso. Okay? Earlier, kanina, sa direct, you are computing for the number of peso required for you to acquire 1 foreign currency unit. But in this case, sa indirect exchange rate, you will be computing how much foreign currency unit are required for you to acquire 1 peso or 1 local currency unit. Okay? So in this case, so to convert number of foreign currency, okay, over your indirect exchange rate, so that means you will have 20,000, okay? In order for you to have 20,000, okay, or to compute for the value of um this 20,000 foreign currency in peso, you just simply divide it by its indirect exchange rate. Okay? So since kanina, you are required man to have 20,000 foreign currency unit, okay? So to convert it, guys, all right? To convert it into local currency unit or Philippine peso, if ever what is given is the indirect exchange rate, you just simply divide it by the exchange or the indirect exchange rate. So that means if you are if you have 20,000 foreign currency unit requirement, you just simply divide it by your indirect exchange rate to compute for its equivalent to local currency unit or peso currency. Okay? If you have noticed earlier, when the given is direct exchange rate, all right? When the given is actually the direct exchange rate, we simply multiply, okay? We simply multiply the amount of our direct exchange rate to compute our total local currency unit required, no? So if it's direct exchange rate, so you just simply multiply the direct exchange rate to the number of foreign currency unit required. Pero if what is given is indirect exchange rate, you need to do is to divide it para ma-compute nimo kung how much local currency unit is required for you to have para ma-reach nimo ang imong 20,000 na foreign currency units. Okay? So another example, if our exchange rate is 1 Philippine peso is equal to 0.20 foreign currency, so that means, and if the number of foreign currency required is 20,000, okay, so you just need to compute first for your indirect exchange rate. So in this case, your indirect exchange rate will be 0.20 or zero point 0.20 foreign currency over 1 or simply 0.20. So you need to convert it by, you can convert it into Philippine peso by having 20,000 divided by 0.20. Okay? Since 0.20 is our indirect exchange rate, which is again coming from 1 over 1.20 from our formula. All right? Okay. So that is indirect exchange rate. So if you have noticed, you should be very careful in computing later on the total required local currency unit. If what is given is direct exchange rate, then you simply multiply the total number of foreign currency units together, or you just need to multiply the direct exchange rate and the total number of units ng foreign currency required para ma-compute nimo kung pila ang iyang equivalent into local currency unit. However, if what is given naman is the indirect exchange rate, so what you need to do is to divide it sa imuhang total number of foreign currency para ma-compute nimo ang equivalent niya into local currency unit. Okay? Now, to continue our illustration, we have here the exchanges or the changes in exchange rate. So, as we all know, as mentioned earlier in our introduction, that it's one actually of the business risk that an entity may face. All right? So, this fluctuation, okay, of your exchange rate is actually personified by strengthening, and weakening of your Philippine peso or of your local currency unit. So again, put it in your minds that when we are talking local currency unit, of course, our local currency unit in the Philippines is Philippine peso. Pero that's not always the case kasi nga, local currency unit could differ from different countries. For example, the local currency unit in US is US dollar. In Japan, it's Japan yen. Or in Singapore, it's Singaporean dollar. Alright? So, this local currency would depend kung asa ang nationality niya. Alright? Pero in the Philippines, of course, our local currency unit is Philippine peso. So, what will happen when your local currency or your Philippine peso strengthens? Okay? That means nag-strengthen daw ang power sa imuhang Philippine peso. Okay? So, when your Philippine peso strengthens, companies who import goods from foreign countries would actually want this, okay? Companies who import goods from foreign countries want a strong peso. What does it mean? Okay? Nganong gusto man sa ato ang mga importer nga strong ang ato ang peso? What happened di ay when our peso strengthen? Okay? So that means if the peso strengthens, for example, from 1.2 direct exchange rate, it becomes 1.1. Okay? So ang direct exchange rate niya will decrease from 1.2 to 1.1. So that means, based on our discussion earlier, direct exchange rate, this is the number of peso required for you to earn a particular dollar. So that means from 1.2 to 1.1, let's say you are required to have $1,000, okay? You are required to pay $1,000. So that means, okay, that means if you are required to have $1,000, you need to pay 1.2 pesos per dollar. Okay? So how much you will be paying if you would like to pay in dollars? So let us say 1.2. So 1.2 times $1,000. So that means, of course, you will be paying a total of 1,200. How in pesos? Okay? 1,200 in pesos. But however, when the Philippine peso strengthens, that direct exchange rate will be reduced. Okay? Mugamay ang atong direct exchange rate. So that means when our direct exchange rate reduces, so from 1.2 to 1.1, instead of paying 1,200 for a 1,000 foreign currency units, you will pay na lang 1,100. Okay? So of course, if we are the importer, since we are the ones who will be paying man, in that case, if we are the importer, so that means we are really be glad, no? That is really be on our advantage if the Philippine peso strengthens kasi nga it will reduce the number of peso required for us to pay that particular foreign currency denominated transaction. Okay? However, a strong Philippine peso is not good for companies who want to sell their goods abroad. Of course, it is also disadvantage if ever you are the exporter. Why is it that if you are the exporter this time, nganong disadvantage man siya on your part? Of course, when the Philippine peso strengthens, of course, the value of your peso this time will be, of course, strengthen man, 'di ba? So that means they will now, instead of receiving 1.2, okay, you will no longer receive 1.2 but you will be receiving 1.1 na lang. Okay? So for example, kanina, 'di ba, kita ang nagbayad kapag kita si importer. So that means if there is strengthening of peso, okay, this advantage sa ato ang part. Instead of paying 1.2, ang atong bayaran na lang will be 1.1. Pero when we are the exporter, okay? When we are the exporter, meaning kita ang bayaran sa foreign currency nato na transaction, instead of receiving 1.2, ang atong madawat na lang will be 1.1, no? If that's the case. All right? If that's the case. So that means when the Philippine peso strengthens, your direct exchange rate decreases while your indirect exchange rate increases as well. Okay? So, baliktad pud ang case when there is weakening of Philippine peso. Kapag mag-weaken ang Philippine peso, baliktad siya, your direct exchange rate will increase, alright? So from 1.1 to 1.16, while on the other hand, your indirect exchange rate will reduce as well. Okay? So I hope that these exchange rates no changes are clear. No, what will happen if there are increase in direct exchange rate or decrease in our indirect exchange rate? What is its effect sa ato ang accounting? Because later on it will affect no due to these fluctuations, due to this increase or decrease in foreign currency transactions, foreign currencies nato, it may actually require us to record gain or loss on a specific dates. Okay? Now, to continue our illustration, we have here ways on how to determine foreign currency transaction. Okay? As what I have mentioned earlier, that there is only foreign currency transaction when there is foreign currency involved. Okay? No, regardless kung asa ang both parties. Okay? Example, let's have number one, transaction between domestic corporation and a domestic corporation. However, the transaction is settled in domestic currency. Okay? Domestic currency. Domestic corporation, as we all know guys, domestic corporation are those corporations who are operating and are following the corporate code in the Philippines, 'di ba? Those are domestic corporation. So if there are two parties involved in a transaction and that particular transaction is settled in a domestic currency, then of course, since there is no foreign currency involved in that transaction, then that will be considered as not a foreign currency transaction. Okay? It is not foreign currency transaction to domestic corporation. Sa both domestic corporation, it is not considered as a domestic or it is not considered as a foreign currency transaction because no currency transaction is involved. Alright? And of course, we don't have foreign corporation here since both parties are domestic corporations. Okay? So in that case, domestic, and it's settled into domestic corporation, no foreign currency transaction. Okay. Now, second case, parties involved are domestic corporation and a foreign corporation. O, okay, ito na, meron ng involvement ni foreign corporation. Si foreign corporation, it is a corporation that is originated abroad or is following corporate laws on their country of origin. Pero what if they are settling their transaction in our domestic currency? Okay? Domestic currency. Okay. So in this case, guys, for example, we are the domestic corporation. Okay. We are domestic corporation. If the foreign corporation will be paying us in domestic currency, example, sa Philippines, our domestic currency is peso. What if since si foreign currency transaction daw will be settling the transaction using domestic corporation using domestic currency, that means the foreign currency will be or that the foreign corporation will be paying us using peso. Okay? Domestic and foreign currency. A domestic corporation and a foreign corporation. The foreign corporation will pay peso to domestic corporation. Okay? So, in that case, meron bang involvement ng foreign currency? There is a foreign corporation but no involvement in foreign currency. Since there is no foreign currency involved in that case, then there is no foreign currency transaction to the domestic corporation. Okay? Since ang domestic corporation is Philippines and then ang gibayad ni foreign corporation is Philippine peso, which is the domestic currency unit ni Philippine corporation, then that means there is no foreign currency transaction in that case. Okay? Pero, in our second case, what if same domestic corporation and a foreign corporation, but this time it is the domestic corporation who will pay the foreign corporation and the payment will be in domestic corporation. Alright? Si Philippine corporation or si domestic corporation magbayad kay foreign corporation. Ang gibayad ni domestic corporation is Philippine peso. Okay? Ang gidawat ni foreign corporation is Philippine peso. In that case, is there any foreign currency involved on the point of view of the foreign corporation? Answer is yes. Since what will be receiving by that foreign corporation is Philippine peso, then that means that is considered as a foreign currency transaction on the point of view of that foreign corporation. Okay? Kasi ang domestic currency ni foreign corporation dili man peso. Okay? So that means there is an involved foreign currency transaction. Okay? So that only means guys na dili basihan whether kung naabay transaction ang duha ka countries, okay? Or ang entities from different countries, but ang ato ang basihan to determine whether there is a foreign currency transaction is whether naabay involved na foreign currency sa settlement. Okay? Kay bisan pa og domestic and foreign currency and then walay foreign currency transaction ang involved, walay foreign currency transaction ang nahitabo as well. Okay? Now, considering further, si number 3, domestic corporation and foreign corporation as well. Pero this time, ang gibayad nato or ang settlement is through foreign currency. Okay? Foreign currency ang ato ang foreign currency ang ato ang gibayad. So, in this case, guys, ang gibayad ni foreign corporation is dollar, for example. Okay? So, in this case, there is a foreign transaction. Okay? There is a foreign currency transaction since what we have received as a domestic corporation is dollar. Pero on the point of view naman ni corporation this time, if we have a transaction sa ilaha and then ang ato ang gibayad is also dollar, then that means no foreign currency transaction. Kasi nga, ang ilahang domestic corporation or ang ilahang domestic currency is dollar, tapos ang ato ang gibayad, ang ato ang settlement is also through dollar, then that means walay involved na foreign currency. Alright? Then that means no foreign currency transaction take place. Okay? I hope that is clear, guys. And lastly, this is very obvious when there is two parties, both foreign corporation, and they are settling their transactions also in on foreign currency, then that means no foreign currency no foreign currency transaction take place as well. Okay? Now, there are actually three important dates to consider in foreign exchange transactions. So this is also the same dates where we will be recognizing gain or loss, no, on foreign exchange transactions. Okay? First date is the transaction date. Obviously, guys, this transaction date, this is the date when the purchase or sale of goods or services or currency takes place. Okay? So for example, you have imported on December 1, okay? There is transaction date, no? On that one, on that date, you are binded to pay or you are binded to sell, okay? So that is considered as the transaction date. All right? Another is the balance sheet date, guys. Si balance sheet date, this is the end of your accounting period. Okay? So, this is the date of your balance sheet. Okay? For example, you are using calendar year. So, that means usually, common man na ginagamit ng mga entities are your calendar year. So, that means the balance sheet date usually falls on December 31. Okay? So, that is also the first date, guys, where we will recognize or we will compute forex gain or loss. Okay? I-compare nimo ang value sa imuhang utang, sa imong payable, or sa imuhang AR from balance sheet date and from the transaction date. For example, from transaction date, it's only this amount of money. Pero on the balance sheet date, it might increase or decrease due to the fluctuation of the foreign exchange. So that means we have the chance to recognize any gain or loss on that balance sheet date. Alright? And lastly, the settlement date. Settlement date, this is the date where we pay. no? Kung kita si importer, this is the date where we pay. Pero kung kita si exporter, this is the date where we receive the payment. Okay? So that is the three important dates to consider in foreign exchange transactions. Okay. So we also have different rates in foreign exchange, guys. We actually have five. The spot rate symbol is SR. This is actually the rate today and it's applicable today. Okay? So these rates will be used in our future na mga discussions. Also, we have future rate. Future rate from the word itself, future. It's the rate today, but it is applicable in the future. Also known as forward rate. We also have historical rate or the spot rate in the transaction date. All right? So historical rate is the transaction date spot rate. Closing rate is the spot rate in the balance sheet date. And the actual rate, guys, is the spot rate in our settlement date. Okay? So please familiarize all these types of exchange rates. Okay. So this time, let's proceed with import and export unhedged transactions. So what do we mean by unhedged transactions? So that means kung ang ato ang import and export transactions are unhedged, meaning we don't do derivatives. We don't use derivatives in the first place in order to hedge possible gain or loss. So that means it's pure import and export transaction without undertaking into possible derivatives. Okay? So later in our later na mga topics in this subject, we will be discussing hedging transactions. But this time, since we are still discussing the basics of foreign exchange transactions, okay? So let's consider without hedging transactions muna. All right? So in an unhedged import and export transaction, the only relevant exchange rate would be the spot rate as of the date of transaction, balance sheet date, and the date of settlement. Okay? So if we are computing basic computations or basic problems in foreign exchange transactions, so you really need to highlight the spot rates on these three important dates. The spot rates on the transaction date, balance sheet date, and the date of settlement. Because as what I have said earlier, it's on the balance sheet date where you will compute gain or loss, no, that has happened in the previous year or in that particular year, and then you will also compute any gain or loss prior to the settlement of that particular transaction. All right. Spot rates are classified as either buying or selling, also called as bid and other rates. So later on, we have two types of rates, the buying rate and the selling rate. So if domestic entity exports, so the buying rate is used since this would be the price that the foreign buyer would pay for the goods. Pero if the domestic entity imports, then the selling rate is used. Okay, for easier understanding, guys, you take this as your guide, no? Usually baliktad siya. For example, we are exporting, okay? So 'di ba, if we are exporting, that means we are selling, right? We are selling. Kung naga-export ta, we are the sellers. Baliktad siya. If we are the seller, if you are exporting, okay, you use the buying rate. Okay? So, exporting, so kita si seller, alright? Pero, if you are the exporter, you use the buying rate. Because, the buying rate is used, no? The buying rate is used since this would be the price that the foreign buyer would pay for the goods. Okay? Kaya that's the amount of the payment that will be made by the buyer. So that is why if you are the exporter, you use the buying rate. However, if you are the importer, okay, you use the selling rate. Okay? If you are the importer, you use the selling rate. Okay? Sige. Now, suppose the domestic company exports goods on FOB destination, guys, free terms, on the date of transaction, the spot rate to be used will be as of the date when the goods reach the buyer, the point when legal title is passed under the free term. Okay? As we all know, there is only transfer of ownership on the point of destination kapag FOB destination. So that means if it's the free term FOB destination, then the spot rate will be the spot rate, okay, as of the date when the goods reach to the buyer kapag FOB destination. Pero kung FOB shipping point naman, then we don't have any problem kasi the spot rate that we will be using is the spot rate on the date when the goods are actually shipped, no? Dili na nato paabuton nga moabot pa sa seller ang ato ang goods. So kapag FOB shipping point, you use the spot rate on the date where the goods are shipped. All right. Another important points that we need to remember, the domestic entity recognizes forex gains or losses as the spot rate changes during the aforementioned dates only. So as mentioned kaganina, when there are changes in the spot rate from transaction date to balance sheet date, you recognize gain or loss. And another date where you will be recognizing gain or loss when there are changes in the spot rate from the balance sheet date and the settlement date. Alright? So for an instance, if the domestic entity is an exporter, thus it has an outstanding accounts receivable. Okay? So kung exporter ta, kita ang namaligya, so that means we have the receivable. And the buying spot rate increases. Alright? So if, of course, if we are the exporter, we use the buying spot rate. Okay? And when the buying spot rate increases, of course, we recognize gain. Okay? In that case, the entity recognizes forex gains to be recorded in the profit or loss. Yes, correct. Any forex gain or loss will be recognized or will be recorded sa atuang statement of profit or loss or income statement. Okay? So, together with an increase in accounts receivable. There is a gain and there is an increase in accounts receivable. Sir, nga nung nag-increase man ng accounts receivable? Because of course, the spot rate has increases or the spot rate has increased. Baliktad, of course, siya guys, when the spot rate decreases. If you are the exporter and the buying rate decreases, then you would also be recognizing a forex loss and a decrease in your AR. Alright? Sige. To use that important na mga concept, let's use it into an illustration or a problem. Alright? Let us say we have here importing transaction. We have an exposed liability. Alright? Exposed liability. Importing transaction. Alright? Nga nung exposed liability man, what do we record man kapag import transaction? Kapag import, we are the ones who buy. Alright? We are the ones who buy. So that means we are the ones who will recognize accounts payable. Okay? And that accounts payable, guys, is exposed to risk, exposed to possible increase or decrease. Alright? And again, since this is an importing transaction, so which rate ato ang gamiton? Buying rate or selling spot rate? Okay? So, kapag importing, of course, we will use the selling spot rate. Okay? We will use the selling spot rate. So, for example, assume that on November 1, 2014, one firm ordered 1,000 units of inventory from US firm for $20,000. The inventory was shipped and invoiced to the Philippine firm on December 1, 2014 to be paid on March 1, 2015. So the firm's fiscal year ended is December 31. Assume further that the Philippine firm did not engage in any form of hedging activity. So that means it is an unhedged foreign exchange transaction or foreign currency transaction. The spot rate for US dollars at various times are as follows. So meron tayong buying spot rates and selling spot rates here. But take note, we have 4 dates here. But based on our discussion, we are only required to give importance sa tulo ka important dates. Okay? Sa tulo ka dates. So in this case, which dates here are to be given importance? Of course, number 1, the transaction date. Okay? So take note guys, although on November 1, there was an order made, but there is no actual commitment made on that date yet. Alright? So that means it is on December 1 where the transaction really occurs. or where the transaction really binds the two parties. So that means your transaction date here will be December 1 instead of November 1. Alright? So that means we will be recording our transaction using the spot rate on December 1, 2014. Okay? And then, we have our balance sheet date of December 31, 2014. So, 4080. And on March 1, 2015, which is our settlement date at 40.65. So, if you have noticed, guys, we are the importer here. So, that means we are the ones recording our liability. So, that means, for example, there is an increase of our spot rate. Then what can you think of this increase in spot rate? We are the importer. We are the ones who records liability. So since it increases, then that means we will be recognizing increase in liability also in this date. Since our liability has increased, we will also be recognizing a forex loss. Okay? But before that, let us prepare muna the journal entry on the transaction date. Okay? So on the transaction date, guys, we have debit to purchases and credit to accounts payable. Alright? Pero, ang atong accounts payable is into dollar because we are paying this transaction in a foreign currency of US dollar 20,000. So that means we will be using the spot rate, selling spot rate on December 1, which is 40.55. So that means we have 20,000 times 40.55. Our accounts payable on December 1, which is our transaction date, is 811,000. Okay? So debit purchases, 811,000. Credit to accounts payable also for 811,000. Okay? Next is um on balance sheet date. So what happened? As mentioned kanina, your balance sheet date increases from 40.55 to 40.80. So if you will now convert your liability on December 31 this time, your liability will now be 816,000. But from the transaction date, you only recognize it for 811. Alright? So from 811, naging 816 siya. So that means there is an increase in our accounts payable. Since there is an increase in our accounts payable, then that means we have to recognize forex loss. So debit forex loss for 5,000 and adjust your accounts payable. So we need to increase our accounts payable since there is an increase in our spot rate on that date. Alright? So, if the problem would ask you guys how much is the total liability on December 31, 20X, so your answer will no longer be 811,000 but 816,000 due to the adjustment of 5,000, which is from 40.80 minus 40.55 times 20,000 US dollar, that is still equivalent to 5,000. Okay? So that will be your adjusting entry on December 31 on the balance sheet date. All right. Now next, let's proceed on the settlement date. So from the settlement date, take note, guys, the spot rate changes again. So from 40.80 to 40.65. So in this case, ning baba siya from 40.80 to 40.65. So since there is reduction in the since there's a reduction in our spot rate, then we will also be recognizing foreign currency transaction gain. So how much gain will be recognized? So we have 40.80 minus 40.65 times 20,000. So we have 3,000 na gain. Also, take note, since it is the settlement date, we will also be paying the liability today on March 1, 2015, which is the settlement date. So also, credit tayo ng cash for 813,000. Sir, why 813,000? Because the spot date or the spot rate on that date na lang is 40.65 na lang man instead of 40.80. So that is why nag-recognize tayo ng 3,000 gain para ma-compensate nato ang total outstanding recorded accounts payable nato na 816,000. Alright? Because if you could still remember, last December 31, your accounts payable was 816,000. Last December 31. Okay? But this time, since there is a reduction in spot rate, so nag-recognize tayo ng gain na 3,000. So that means, ang bayaran na lang nato, alright? Ang bayaran na lang nato in peso to acquire 20,000 US dollar is 813,000. Okay? So that is a an example of an importing transaction. Okay? Kapag importing transaction, so you use the selling rate. All right? And if it's importing, then ang ato ang entry would be partnered with gain or loss and possible increase or decrease in our accounts payable. If we are the if we have importing transaction. Okay? So this time let's proceed with okay. All right, so this is true. So over the 3-month period, the decision to delay making payment cost the firm 2,000. Okay, so 813 cash paid less the original payable of 811,000. So this net amount was recognized as a loss of 5,000 in 2014 and a gain of 3,000 in 2015. Okay, so in the entire foreign currency transaction, what do we have? We have incurred a net loss of 2,000. Okay? Kaya naka-recognize man tag loss sa 2014 nga 5,000 and gain for 2015 nga 3,000. So, in the entire importing transaction, we incurred a loss of 2,000. Okay? Sige. This time, let's proceed with an exporting transaction. So this time, exporting baliktad kay importing. Si exporting, kita ang namaligya. Alright? We are the one who sells. So that is why baliktad ang spot rate nga gamito nato. Since we are the one who sells, we use the buying spot rates. And at the same time, since we are the sellers, we recognize accounts receivable. And what is exposed this time is your asset. No? What is exposed to risk is your AR. So there are tendencies na mag-increase or decrease ang imuhang AR. Alright? Okay. So this time, let's have same transaction. We have 100 units of inventory for 50,000 to a US firm na maligya si exporter og inventory to a US firm and it is to be paid for 50,000 US dollar. All right? The transaction date is on December 1, 2014. So therefore, our journal entry on that date would be debit to AR credit sales since we are the one who sells man. All right? Debit AR credit sales for how much? Of course, you use the buying spot rate on the transaction date, not on November 1, but on December 1. All right? So that is 50,000 times 40 pesos. So you have initial AR na 2 million. Okay? Initial AR na 2 million. Okay? If you have noticed, initially, there is an increase from 40.70, from 40 to 40.70. So obviously, in our balance sheet date, we will be recognizing gain. Since there is an increase man, okay? Since there is an increase, since there is an increase of ano, um uh, increase of increase of spot rate. All right? So, adjustment to accounts receivable needed will be 35,000. Okay? So, that means wala siyang na-prepare na entry. So, ang entry nato pagka December 31, 2014, guys, all right? Ang entry nato dire since we have a gain man, so debit tayo accounts receivable for 35,000, credit to forex gain for 35,000 also. Asa gikan si 35,000, sir? So that is from the new value of our AR right now, which is 50,000 times 40.70, which is the spot rate on December 31 on the balance sheet date. So that is 20,035. You compare it with your initial AR on the date of transaction, the 2 million. So that means we have an accounts receivable of 35,000. Okay? And on March 1, on the settlement date, okay, let's go back. So from 40.70, it becomes 40.60. So there is a decrease in spot rate. So on March 1, we will be recognizing a loss. Okay? All right. Now, this loss, of course, is from the decrease. All right? How much is the decrease? So, point 10. So, point 10 times 50,000 US dollar. So, we have a currency transaction loss na 5,000. Okay? So, on that date, there is also a settlement. So, magbayad na ang ang importer sa atua. So we will be receiving cash for 2,030,000. Instead of 2,035,000, we will be receiving only 2,030,000 na lang since nag-decrease man ang ato ang spot rate on that date. So we will receive na lang 2,030,000 and recognize foreign currency loss na 5,000 to compensate your previously recorded accounts receivable last balance sheet date na 2,035,000. Okay? So I hope that this discussion is clear, especially on unhedged import and export transaction. Okay? Now this time, let's proceed with foreign debt transactions. So just like purchase of commodities, forex gains, losses are also recognized in foreign debt borrowings or grants. Also, the purchase of the goods might have been through issuance of promissory notes and other debt instruments. So if the domestic entity is a borrower, guys, take note of this. It must use the selling spot rate. Okay? Selling spot rate ang gamitin. Pero kung buying naman, and the buying spot rate ang gamitin kapag it lends, no? Kita ang nagpahiram. Kung kita ang nangutang, we use the selling rate. Kung kita ang nagpautang, kita ang magamit ng buying rate. Okay? Sige. We have here our last illustration for this video lecture. Melrose issued a promissory note denominated in foreign currency for the purchase made from an Italian supplier. Now, the following were related transactions Italy, in Italy's foreign currency. Now, on December 1, 2016, Melrose Corporation purchased merchandise from an Italian supplier for a 60-day 18% promissory note for 100,000 Italy currency unit at a selling rate of 1 foreign currency to 74.20. On December 31, the selling spot rate is 1 foreign currency to 74.85, and on January 31, 2017, the selling spot rate would be 1 foreign currency to 75.75. Okay? So this time, same, there are three important transactions or dates nga kailangan nato, the transaction date, the balance sheet date, and the settlement date. And um since we are the borrower here, we are the ones who issues for the promissory note, then therefore we will use the selling rate. Okay? So on this date, we will be recognizing these selling spot rates. Of course, we have 74.20, 74.85 on December 31 and January 31, 2017 for 75.75. So since ano guys, si borrower man tayo dito, then therefore we recognize notes payable. Okay? It's the same with exposed liability. So debit purchases, credit to notes payable. Of course, it's based on the selling spot rate on the transaction date, which is on December 1, 2016. So that's 74.20. So that means your total notes payable in peso is, or in your denominated transaction, or in your local transaction, local currency, is 8,013,600. Okay? And all right, on December 31, 2016, on the balance sheet date, what happened? Okay, there is an increase in spot rate. An increase since we recognize liability, notes payable, so we have incurred loss since nag-increase ang liability natin. Okay? From 74.20 to 74.85. So recognize loss of 70,200 and adjust your notes payable as well. So as a gikan si 70,200, it's from 70.85 versus the previous spot rate na 74.20, multiply it by your foreign currency unit na 108,000. So, you recognize 70,200. Okay? And for you to recognize as well your interest expense. Okay? So, interest expense, so we assume that there is 18%. So, you have 108,000 times 18% times 1 over 12 because that's only good for 1 year. Okay? And then multiply it with the spot rate on that date, which is 74.85. So ang interest expense mo in that case will be 121,257. Okay? Ito lang ang difference kanina sa importing. Kasi sa importing, we don't recognize interest expense. But dito, when we issued notes payable, aside from the notes payable itself, which is exposed to possible increase or decrease, same, we will recognize as well interest expense. Okay? As a result. So in this case, guys, in our December 31 income statement, we will be recognizing our foreign currency transaction loss of 70,200 and an interest expense of 121,257. So aside from the loss that we will be recognizing in our income statement or P&L, we will also be recognizing as well interest expense of 121,257. All right? And also, your notes payable on December 31 will be valued at 108,000 times 74.85, which is also the spot rate on December 31, 2016. So we have 8,083,800. And our interest payable will also be 121,257. It will also be recognized and reported in your balance sheet. And at the same time, your inventory. Okay? Ang inventory na to, guys, will never change. Okay? Your inventory will be valued based on its original amount, okay? Which is 8,013,600 from the spot rate of 74.20 on December 1, 2016. Okay? Inventory will never be adjusted. What will be adjusted lang will be the accounts payable or the accounts receivable if ever there is an exporting transaction. All right. So I think um we have made things clear regarding basic na mga transactions related to foreign exchange. So I hope that we can now determine which transactions are considered as foreign exchange, and we can now compute for the possible gain and losses that can be derived by an entity that is involved in a foreign exchange transaction due to possible fluctuation of our currency rates. So if you have any more questions, clarifications, violent reactions, or even additional inputs, okay, you may actually have it during our virtual class. Okay? And if you still have more time, you can use these references of Dayag and Guerrero for supplemental reading. Okay? So thank you very much for your time in watching this video lecture. I hope that this is a fruitful one, and see you, all right, in our next meeting. Thank you and God bless.